One of the core responsibilities of county government is to administer property taxation to fund essential public services. Property taxes can feel complicated, and assessments, protests, levies, and multiple taxing authorities all play a role. My goal is to give you a clear, high-level overview of how the system works and how the pieces fit together. When we talk about property taxes, there are three major components that work together: assessments, which is how values are determined; protests, which are how property owners help ensure accuracy and fairness; and finally, levies, which is how values translate into actual taxes to fund public services. Each step serves a different purpose, and different offices play different roles in the process. The assessor's office discovers, lists, and values the property. The Board of Equalization, which is the county board, hears the protests and makes sure it's equal and fairly assessed. The taxing subdivisions like county, township, fire department, municipalities, NRD, etc., set their budgets and corresponding levy requests. Finally, the treasurer collects the taxes and disperses to the different taxing entities. Together, these roles form the property tax system. With that overview, let's now start how property values are determined. An assessment is an opinion of market value based on standardized methods and available data. It answers one question: what would this property have sold for on that day? Because markets and property conditions changed, value must be tied to a specific point in time. Nebraska statutes state all real property shall be assessed as of January 1 at 12:01 a.m. January 1 establishes a uniform valuation date. The work may occur throughout the year, but each property is analyzed as of the same market moment using data, models, and market analysis to ensure consistency and fairness. To start, agricultural land is the most straightforward. Agricultural land is classified by its land use, primarily into irrigated, dry land, and grassland categories. Then, productivity of the soil type is arranged into 8 land capability groupings as determined by the Natural Resource Conservation Service and state's property tax administrator. Those classifications ensure each parcel of agricultural land in the state is inventoried by its productivity potential. Then, assessors evaluate the per acre rate that those parcels are selling for in the open market. Naturally, land with higher productivity sells for more than land with lower class soil productivity, so assessments follow the same declining pattern. Since agricultural land is assessed at 75% of market value, the market sale price per acre are reduced by 25% and are assigned to each soil class and then applied consistently across every parcel based on its specific soil makeup. This ensures that land with similar productivity is valued similarly countywide. Then we get into residential properties. Nebraska Revised Statute 77-112 defines actual value as market value, which must be indicated using one of 3 accepted approaches: the cost approach, market approach, and income approach. Cost approach's main question when assessing property is, what would it cost to build this property today? And that is what most Nebraska counties rely on when assessing residential property. This is because it allows for consistent treatment of properties. It still works even when the sales data is limited, and it ensures uniformity across the county. But even when using the cost approach, depreciation is calibrated from market sales, so the market still ultimately drives the final value. The market approach asks, what are similar properties actually selling for? This works well with areas of strong sales activity and properties with abundant market data. It is used in larger counties like Douglas and Lancaster because there are enough sales to support it statistically. Land valuations in most counties are established based on comparable sales of vacant land in that neighborhood or region. Finally, the income approach asks, what income does this property generate? This approach first determines net operating income, NOI, and applies a capitalization rate, cap rate, and is converted into a value. This works for commercial properties, apartment complexes, rental housing, and retail properties. When valuing any property, assessors begin by separating 2 components: the land and improvements. In appraisal terms, improvements means the structures attached to the land, your home, garage, outbuildings, or other permanent features. It does not refer to cosmetic upgrades. The most common and relevant approach when assessing residential is the cost approach. The cost approach starts by estimating what it would cost to rebuild the home new today. To do that, assessors gather detailed information about each property. This includes things like type of siding, whether it's brick, LP, or vinyl, the roofing materials, the quality and type of windows, and the total square footage of the home. They also look at the layout and structure, including the number of stories, whether there's a basement and if it's finished, as well as the overall size and design of the home. The year the home was built is also an important factor in that evaluation. Once those details are entered, the system uses Marshall and Swift, which is a nationally recognized cost manual used by assessors, appraisers, and insurance companies across the country. These costs are updated quarterly and adjusted for local Nebraska conditions. When lumber prices spike or labor costs rise, replacement costs automatically adjust. This produces a replacement cost new, RCN. Knowing the replacement cost of a property doesn't mean that it is its assessment, but it means that we now know what each property is generally worth if it is in brand new condition. But we know that properties wear out with age, so assessors are frequently inspecting properties to monitor the condition of houses as they age. Some houses are neglected from routine maintenance, and others are remodeled to near new condition. Assessors rely on these general categories to classify the condition of the interior and exterior of the properties over time. At the lowest end of the scale are properties that have little to no value. These are structures that may be unsafe, uninhabitable, or even slated for demolition. From there, you move into homes in very poor condition, which may have major structural issues like foundation or roof failure and would require significant renovation to be livable. Next are properties in fair condition. These homes typically show deferred maintenance, outdated systems, and visible wear, things like older roofs, windows, or siding, and would likely need substantial updates. In the middle of the scale is what we call average. These are homes with typical maintenance for their age, nothing majorly wrong, but showing normal wear and tear over time. Above that are homes in good condition. These properties are typically well maintained, may have some updates like newer kitchens or mechanical systems, and show a higher level of care. Then you move into very good condition, where homes have had significant renovations, modern updates, and show limited depreciation compared to their age. At the top of the scale, these are properties in excellent condition. These are nearly new homes with high quality materials, minimal wear, and often comparable to new construction. Keep in mind these categories are not always whole numbers. Assessors may use intermediate ratings such as 3.5 or average plus to more accurately reflect a property that falls between two conditions. In establishing this condition ranking for properties, a common question is, how do we know what the inside looks like if we can't see it? The answer is simple. We rely on homeowners. Assessors provide property record cards and surveys that owners can complete to help ensure accuracy. Accurate records are essential to fair valuation. Once a replacement cost is estimated, depreciation is applied. Depreciation reflects how the market values the property in its current condition compared to new construction. Depreciation generally falls into three categories. Physical depreciation. Homes wear out over time, which is both exterior and interior conditions. Functional depreciation. Design or layout issues that may affect market appeal, such as only one bathroom for a large home. Economic depreciation reflects external factors such as location or surrounding influences. For example, homes closer to a large municipality typically sell higher than similar homes far away. That location difference is captured through economic depreciation. Depreciation is not guessed. It is pulled from sales data. The land value and outbuilding value are removed from the sale price, leaving the sale price attributable to the house itself. That figure is compared to the RCN, replacement cost new, to determine the market percent good. Sales from the last 3 years are analyzed by location and age to build depreciation schedules. Average condition homes are used as the baseline, with adjustments for fair, good, or excellent condition. Together, these adjustments are intended to align replacement costs with observed market behavior, producing an assessed value. Now imagine applying this process not only to one property, but thousands of properties across the county. This is where computer-assisted mass appraisal software comes in, often referred to as CAMA. Once data is entered, the software calculates RCN, applies depreciation, adjusts for age and condition, adds land and outbuildings, and produces a value. This is the definition of mass appraisal: standardized, data-driven, and statistically tested. In practical terms, property characteristics such as size, construction type, and quality are entered into the system. Those characteristics are matched to the cost data to estimate replacement costs. From there, adjustments for age, condition, and market behavior can be applied consistently across similar properties. Because assessments are opinion of value, it is important to measure how well they reflect the market. When a property sells, that sale provides real-world market evidence. Each year, the assessor's office reviews recent qualified sales and compares those sales to prior assessments to evaluate its work and make adjustments where needed. That comparison helps show how closely the assessment aligned with what a willing buyer and willing seller ultimately agreed upon. When many of those comparisons are analyzed together, they provide a broader picture of how the system is performing. This is where the concept of equalization comes in. The Nebraska Constitution requires that taxes be levied by valuation uniformly and proportionately upon all real property to ensure fair and equal property valuation. To evaluate this, the Assessor's Office, Nebraska Department of Revenue, and Tax Equalization Review Commission, TERC, rely on recognized statistical measures. Two commonly referenced measures are the coefficient of dispersion, COD, which evaluates uniformity. Uniformity means that similar properties are treated consistently. Homes with similar characteristics like size, age, and condition should be assessed at similar values so that no one property is unfairly higher or lower than its peers. The other is price-related differential, PRD, which evaluates proportionality. Proportionality means that properties at different value levels are assessed fairly in relation to each other. Lower, mid, and higher value properties should all be assessed at roughly the same percentage of their market value, so no one group carries more than its fair share of the tax burden. These measures allow assessment performance to be captured objectively against statewide standards. All three bodies use these standardized tests to ensure that all counties in the state are valued at an equal level. One way to visualize how equalization affects results is to examine value per square foot plotted against property age. The chart on the left reflects values before updates were applied. The chart on the right shows the same data after review and adjustments. As you can see, it is a more predictable trend with the age of the property. That said, while mass appraisal structures accomplish the tall task of valuing hundreds or thousands of properties at a single time, mass appraisal models will have a limited accuracy on unique properties and properties in which the assessor's data is incorrect or incomplete. Also, market feedback can take time to work its way through the system. That is why the review process is so important. If a property owner believes their assessment does not reflect their property accurately, the protest window provides an opportunity for more immediate property-specific review. The more accurate property data is at the individual level, the more reliable the overall system becomes. That is why protests are such a helpful part of the process. This is where you, the property owner, has a direct role. True equalization depends on accurate property data. If something is wrong in your assessment, it not only affects you, but every other property owner. Protests are not a bad thing. In fact, they are essential. After the assessor's office completes its valuation work and statistical testing, notices of property valuations are mailed on or before June 1. If you review your notice and don't agree that the assessed value reflects a price that you could sell it for, review your property record card online and see if something is incorrect. You'll want to look over key details that drive value, things like square footage, whether the basement is finished, the condition of the interior, the siding or exterior materials, and even the age of the structure. Assessors are human, errors can happen, and property information might not always be visible to them. If you bring in photos, documentation, or allow interior review where appropriate, it can be easily adjusted. Because at the end of the day, if the data is wrong, the values will be wrong. Another valid reason to protest is comparison. If you know of several homes in your area that are in similar age, size, and condition, those properties should be relatively equal in value. If they are not, that is exactly what the protest process is designed for. To show you a comparison example, looking at this chart from the previous slide with the data points in a tight correlation, a point outside of the trend like this would be a reason to protest by comparison. When protesting using the comparison method, you want to be sure to bring multiple examples to show that you are systematically outside of the typical range. Equalization is more than just cherry picking the lowest value to compare to. If you found a low valued home that is also outside of the trend, like this one, it does not mean that your home would also be valued at that level. It is more likely that another error was found, and equalization does not happen by correcting one error with another one. That is why you need to find a group of comparables when protesting. The protest process is an important part of the system. It provides property owners with an opportunity to present additional information and ensures that valuations can be reviewed in a structured and impartial setting. Real property protests must be filed with the county clerk on or before June 30th. In some counties, once a formal protest is filed, a neutral referee may be assigned to review the property and the concerns raised. If appropriate, the referee may conduct a site visit and issue a written recommendation to the Board of Equalization to consider. Then the Board of Equalization meets to hear and decide protests beginning on or after June 1 and ending on or before July 25th. The responsibility of the Board of Equalization is not to set initial values, but to review the evidence presented and determine whether the assessment meets the legal standard of uniform and proportionate valuation. The goal is to be equal, not perfect. If a property owner disagrees with the Board of Equalization's decision, an appeal may be filed with the Tax Equalization and Review Commission, TERC, which provides independent review at the state level. Appeals must be filed on or before August 25th. This layered structure, starting with the assessor's office, where statistical checks are used to ensure values are in line, followed by the protest process with an independent review of a referee when appropriate, and a decision of the County Board of Equalization, and finally, the option to appeal at the state level, is designed to promote fairness, transparency, and consistency throughout Nebraska. Now that we've discussed how values are developed and how they can be reviewed, the next step is understanding how those values translate into property taxes. This is where the biggest misunderstandings happen. Once property values are established, those values move into a larger budgeting and levy process. The values are the foundation of the calculations. Each taxing subdivision sets its own budget based on the services it provides. A levy rate is then determined based on the budgetary needs of each taxing authority based on the total assessed value of that taxing district. Each property is only levied for the taxing authorities it's associated with and is set by October 20th. Property taxes are calculated by applying that levy rate to a property's assessed value, which fund those public services that were budgeted for. Your property tax bill is made up of many taxing authorities, not just the county. These can include county, municipality, fire district, school district, township, historical society, NRD, Ag Society, and ESU Community College. The county portion of your taxes goes towards the core services that keep the county running, from maintaining roads, bridges, and handling snow removal to operating the courthouse, jail, and public defender system. It all plays a role. It also supports inmate care, building maintenance, and the employees who provide these services. Beyond that, it helps fund extension and community programs that benefit residents across the county. All of these pieces work together to keep things operating smoothly. Let's walk through an example of a tax statement for a $250,000 home in town. With a total levy of about $1.59, that puts the total taxes at roughly $4,000. Now, what actually is paid is usually a little less because of state tax credits, but this is the starting point. That total is calculated by taking the value of the property, dividing by 100, and multiplying by the levy rate to get the total taxes paid. From there, the total can be broken down and to show how much goes to each taxing entity. For example, The school levy is about 91 cents. So using that same formula, that comes out to nearly $2,300 going to the school district. About 900 goes to the city and around 590 goes to the county, which supports all those services we just talked about. That's less than a typical phone bill, about $50 per month. The rest is split among other entities. About 80 goes to the NRD, 50 to SCC, around 38 to ESU, $7 to the Ag Society, and just a couple dollars to Historical Society. As you can see in the pie chart, about 60% of the property taxes on a home goes to schools. Now let's take a look at what taxes look like on farm ground. For this, we will use a dry land quarter. Say you have 160 acres assessed at $795,200. To find the actual value of ag land, because it is assessed at 75%, you divide by 0.75, which puts it at just over $1 million in value. Then divide that by 160 acres, and you get about $6,600 per acre for actual value. To get the total taxes paid, you take the assessed value, divide by 100, times by the levy of $1.14, and you get the total taxes paid, which comes to roughly $9,100. Again, usually a little less after state tax credits. When you break that down, $6,100 goes to schools, $1,800 to the county, $340 to township, $255 to NRD, $240 to the fire department, $160 to SCC, $123 to ESU, $22 to the Ag Society, and $5 to Historical Society. So this piece of farm ground with no children living on it, there is about 70% of property taxes still going to the schools. While many taxing authorities make up your property taxes and will vary by location, in many Nebraska communities, the largest share of a property tax bill supports public schools, typically around that 60 to 70%. It is also important to recognize how much tax rates can differ, even across relatively short distances. Just within Gage County, school levy rates alone can vary significantly. They range from about 55 cents up to just over $1.08, depending on the district. Because schools make up the largest share of property taxes, that 53-cent difference can have a real impact. On a $250,000 home that we looked at earlier, that difference amounts to roughly $1,300 in taxes paid. And when you apply that same difference to our quarter of dry land example, it comes out to $4,200. What's important to recognize is that the difference in school levies affects farm ground significantly, even though no one lives on that ground and it doesn't directly use the school system. However, that land does benefit from services like county roads, township maintenance, the NRD, fire protection, and ag-related services, but not schools in the same way as a residence does. The Southern and Diller-Odell school districts border each other, yet there's about a 46-cent difference in their school levy. That means if two similar quarters sat across the road from each other with the same values as our example, the one in Southern would pay nearly $3,700 more in taxes than the one in Diller-Odell, simply because of the school district it's in. Property values and levies are two sides of the same coin when it comes to property taxes. One determines how much is needed through budgets and levies, and the other determines how that amount is distributed fairly. This is why equalization matters. Values do not set taxes. They distribute the tax burden fairly. Property values and levy rates work together. If overall property values increase while budgets remain stable, levy rates may decrease. If the overall values decrease while budgets remain constant, levy rates may increase in order to generate the required revenue. To show how this works in a county budget, I put together a simple example. In 2024, the total land values were about $4.2 billion, and the county budget was $11.2 million. That resulted in a levy of 26.66 cents. In 2025, land values increased to $4.6 billion, while the county budget increased slightly to $11.5 million. That brought the levy down to about 24.9 cents. So even though valuations increased about 10%, the budget only increased about 3%, which caused the levy to decrease by about roughly 7%. This shows that rising property values don't always mean higher taxes. It ultimately depends on the budget set by the taxing authorities. Levies set taxes, not valuations. A simple way to think about property taxes is to picture your total tax bill like a pie. That pie represents the total budget, the amount of money needed to fund public services in your community like schools, roads, law enforcement, and other local services. Property values determine how that pie is divided. They decide who shares the pie and how big each slice is. If values rise evenly across the board, everyone's slice stays about the same. So assessments are determining your fair share of the total pie. Then you have the levy, which determines how much your slice costs. Another factor to keep in mind is inflation. You can think of this like rising ingredient costs. As the price of materials, labor, and services goes up, it takes more to bake the pie, which can lead to higher budgets over time. This chart shows the value index versus the tax index in Gage County. What it highlights is that while property values have increased significantly over time, taxes have not risen at the same rate. Since 2000, total property value in Gage County has increased by 363%, which averages roughly 6.3% per year. Over that same period, property taxes levied have increased about 203%, or around 4.5% per year. So while values have risen sharply, taxes have grown at a slower pace over time. This shows that the tax growth is more gradual and tied to budget needs, not simply rising valuations. To wrap this all together, this is why equalization matters. When the budget is set and everything is assessed and equalized, property values determine how the pie is divided. That's your share. The levy determines how much that share costs. Lower value homes have a smaller slice, and higher value homes have a larger slice. If values aren't accurate, some people pay more than they should, and others pay less. At the end of the day, values determine your share, and levies determine the total. Fair values create fair taxes. Let's walk through a timeline of key dates throughout the year and how responsibilities are split between county and public. Everything starts on January 1st. This is the assessment date, when property values are set based on the condition and status of the property on that day. By March 19th, those values are verified. This means that the assessor's office has completed their work and finalized the valuations for the year. May 1st is an important date for the public. That's when personal property tax filings are due and when first half of property taxes become delinquent. On or before June 1st, valuation notices are mailed out. This is when property owners are officially notified of their values and can begin reviewing them. By June 30th, protests must be filed if there are concerns. This is also the deadline for the homestead exemption applications. By July 25th, final determinations of value are made after the protest process has been completed. On August 20th, values are certified, meaning they are finalized for tax calculation purposes. If property owners still disagree after that point, they have until August 24th to file an appeal with Turk at the state level. September 1st is when the second half of property taxes become delinquent. In mid-September, between the 14th and 23rd, pink postcard meetings are held. These are public hearings where taxing entities review and discuss their proposed budgets. By September 30th, those budgets are officially adopted. On October 20th, levies are based on those adopted budgets. By November 22nd, the tax list is delivered to the treasurer's office. And finally, by December 1st, tax statements are mailed out to property owners. So this timeline shows how values, budgets, and levies all come together throughout the year to determine your final tax bill. Thank you for taking the time to better understand how the property tax system works. If you have any questions or would like more information, please don't hesitate to contact your county representative or your assessor's office.